This question examines the uses of the statement of financial position, balance sheet, and asks students to identify the exception. The balance sheet presents a company's assets, liabilities, and equity at a specific point in time, providing information about financial position rather than operating performance over a period. The keyword, except, indicates that one option is not primarily supported by the statement of financial position alone. Students should distinguish between information obtained from the balance sheet and information that requires the income statement or other financial reports. In particular, profitability and operating performance are measured using revenues and expenses accumulated over an accounting period, not merely by examining assets and liabilities at one date. A. Computing rates of return. Incorrect. The statement of financial position supplies information on assets and equity, which can be combined with income statement data to calculate ratios such as return on assets, ROA, and return on equity, ROE. Thus, it provides an important basis for these calculations. B. Evaluating capital structure. Incorrect. Capital structure refers to the mix of debt and equity financing. The balance sheet clearly shows liabilities and shareholders' equity, making it useful for this purpose. C. Assessing liquidity and financial flexibility. Incorrect. Current assets, current liabilities, and long-term obligations reported on the balance sheet help users evaluate liquidity and financial flexibility. D. Determining profitability and assessing past performance. Correct. Profitability depends primarily on revenues, expenses, and net income, which are reported in the income statement, not the statement of financial position. The balance sheet alone cannot determine profitability or operating performance. Correct answer. D. Determining profitability and assessing past performance. Exam tip. The statement of financial position shows financial position at a point in time, while the income statement measures profitability and performance over a period. This question tests students' understanding of how external investors use the income statement. The income statement reports a company's revenues, expenses, and profit or loss for an accounting period, making it an important tool for evaluating operating performance and future prospects. The keyword, except, means students must identify the purpose for which the income statement cannot normally be used by an external investor. A useful approach is to distinguish between publicly available financial information and internal management information. External investors have access to published financial statements, but generally do not have access to confidential internal budgets unless management voluntarily discloses them. A. Analyze the company's performance compared to the budget. Correct. External investors usually do not have access to the company's internal budget, which is a management planning and control document. Therefore, they cannot use the published income statement to compare actual performance against budgeted results. This is the exception. B. Compare the company's results to those of its competitors. Incorrect. Investors frequently compare revenues, margins, and profits with those of competing firms to evaluate relative performance and competitive position. C. Assess the risk of the company achieving future profitability. Incorrect. Historical earnings trends and expense patterns help investors assess the sustainability and risk of future profits. D. Predict the company's future revenues. Incorrect. Past revenue growth shown in the income statement provides a basis for forecasting future sales, although predictions are subject to uncertainty. Correct answer. A. Analyze the company's performance compared to the budget. Exam tip. Budgets are internal management documents, while published financial statements are intended primarily for external users such as investors, lenders, and analysts. External users can analyze historical performance, but usually cannot compare it with undisclosed internal budgets. This question tests students' understanding of the purpose of the major financial statements. The key phrase is, provides a summary of the company's operations for a period of time. Students should recognize that some financial statements report information at a specific date, point in time, while others report activities over an accounting period. The company's operations mainly refer to its revenues earned, expenses incurred, and resulting profit or loss from business activities. Therefore, students need to identify the statement that summarizes operating performance during a period rather than financial position or changes in equity. A. Income statement. Correct. The income statement, also called the statement of profit or loss, summarizes the company's revenues, expenses, gains, losses, and net income over a reporting period. It measures operating performance and profitability, making it the correct answer. B. Statement of financial position. Incorrect. The statement of financial position, balance sheet, reports assets, liabilities, and shareholders' equity at a specific date, not the results of operations over a period. C. Statement of shareholders' equity. Incorrect. This statement explains changes in shareholders' equity, including share issues, dividends, and comprehensive income, but it does not summarize the company's operations. D. Statement of retained earnings. Incorrect. The statement of retained earnings shows changes in retained earnings, mainly due to net income and dividends, rather than providing a complete summary of business operations. Correct answer. A. Income statement. Exam tip. Remember the distinction between over a period and at a point in time. Income statement reports performance over a period, revenues minus expenses equals profit. Statement of financial position reports financial position at a specific date, assets equals liabilities plus equity. This question tests students' ability to reconcile retained earnings, dividends, and cash flows. The key is to distinguish between total dividends declared, stock dividends, and cash dividends actually paid. Students should begin with the retained earnings equation. The increase in retained earnings is 125,000 minus 100,000 is equal to 25,000. Since net income is $40,000, total dividends declared equal 40,000 minus 25,000 is equal to 15,000. These total dividends include both cash dividends and stock dividends. Because the stock dividend is $8,000, cash dividends declared are 15,000 minus 8,000 is equal to 7,000. Finally, the question asks for cash paid for dividends, which requires adjusting for the change in dividends payable. First, determine the cash dividends actually paid. The dividends payable account decreased by $5,000, meaning the company paid $5,000 more than it declared in cash during the year. Equals 7,000 plus 5,000 is equal to 12,000. A. $20,000. Incorrect. This overstates the cash payment and ignores the retained earnings reconciliation. B. $15,000. Incorrect. This represents total dividends declared, cash plus stock, not cash paid. C. $12,000. Correct. Cash dividends declared were $7,000, and the $5,000 decrease in dividends payable indicates an additional payment of previously declared dividends, resulting in cash paid of $12,000. D. $5,000. Incorrect. This reflects only the decrease in dividends payable and ignores dividends declared during the year. Correct answer. C. $12,000. Exam tip. For dividend questions, follow these 3 steps. Calculate total dividends declared using the retained earnings equation. Subtract stock dividends to determine cash dividends declared. Adjust for the change in dividends payable to calculate cash dividends actually paid, which is reported in the statement of cash flows.